Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing SuRo Capital stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. SuRo Capital is a fund that invests in high-growth, venture-backed private companies. It primarily invests in social mobile, sustainability, cloud computing, big data, marketplaces, and education sectors. It is structured as a BDC, which is a business development company. BDCs are a type of closed-end fund. In order to qualify as a BDC, the company must invest at least 70% of its assets in private or public U.S. companies with market values of less than $250 million. There are some similarities between REITs, MLPs, and BDCs. All of those structures do not pay income taxes before distributing dividends. Regular companies do. That means regular companies have to deal with double taxation. Dividends are taxed on a corporate level and on the investor level because a company like Microsoft has to pay taxes before it distributes its dividends. Then when you receive the dividends, you have to pay taxes once again. That's called double taxation. Also, BDCs must give back at least 90% of their profits to their investors. All dividends are taxed at the higher tax rate, which means none of the dividends are taxed at the long-term capital gains rate. The company was formerly known as GSV Capital. They're headquartered in San Francisco, California, and founded in 2010. It trades on the Nasdaq and Deutsche Borse. Let's get started with the model. This is a small cap company, 388 million market cap. They're trading at $12.46 a share, and they have 31 million shares outstanding. Here's the company's latest income statement from their quarterly report. The first 9 months of 2020, the first 9 months of 2021, the third quarter of 2020, and the third quarter of 2021. The company receives interest and dividend income on the companies they're invested in. That was $500,000 in the third quarter, $400,000 in the third quarter of 2020. These are the expenses of the company: $1.5 million in stock-based compensation, $370,000 in director fees, professional fees of $600,000, this is mainly legal fees, and $280,000 of other expenses. So they have a net investment loss of $2.2 million. When you buy a piece of a company, you may not receive any payments unless they pay a dividend. You'll probably earn the most money when you sell the stock, and hopefully you sell it a lot more than you bought it for. And that's where most of their gains are, $32 million of realized gains. These are the gains from selling the stock. They had $170 million in the first 9 months of 2021, a big jump from $9 million in the first 9 months of 2020. If they buy stock in a company and they spend $10 million, then a year later they sell that stock for $10 million, they have a zero gain. If they were to sell that stock for $11 million, they would have a realized gain of $1 million. If they sold that stock for $9 million, they would have a realized loss of $1 million. The way to calculate PE ratio, it's market cap over net income. So their market cap is $388 million. If I take their net income of $172 million, which is just 9 months, we should be taking the annual net income, so would be even higher. Let's just say I took the 9-month number. That means they would have a PE of 2.25. If I took the annual number, it would be even better. When you watch YouTube videos or look on Yahoo Finance or other financial websites and see a price-earnings ratio of 2, you might think the stock is extremely undervalued. But that might not be the case. You should really focus on the price to book when looking at a company like this, not so much the PE. This is the company's balance sheet, and this is probably the most important financial statement for a company like this. You want to track their net assets. So they have portfolio investments of $316 million. They have $108 million of cash, so total assets of $428 million. They have pretty much no debt, only $2.7 million. So their net assets are $426 million, which is a lot higher than 2020 of $302 million. It appears the reason it grew so much is because they're paying out stock dividends, not cash dividends. When a company pays you in stock, it's dilutive, so increases the shares outstanding. You could of course turn around and sell the stock, but when a company pays a cash dividend, that doesn't affect dilution. A company would rather pay stock dividends since it saves cash, because when it pays cash dividends, That's less money it has to grow the business. But the business is only as good as its investments. And that's what we'll look at in a little bit. 3 of them are private companies, so I really can't get too much information. But Coursera, ticker COUR, market cap $2.8 billion. Their revenue the last 12 months is $384 million. And Nextdoor, ticker KIND, $2.2 billion market cap, trailing 12-month revenue $152 million. But you could learn a lot more about these companies looking through this company's financials. 23% of this company's entire portfolio is in Course Hero. This company operates an online learning platform for students to access course-specific resources like homework, essays, and tests. They charge a monthly fee of $19.95. And the company's been around for 15 years. The company mentions 4 notable developments. These are their investments: Rover, Nextdoor, Aspiration Forge. They do have a lot more investments, but these 4 recently merged into a SPAC. Rover is an active publicly traded company. These 3 companies are pending, so probably sometime this year they'll go public. Here are 5 more notable developments. 2 of their investments completed an IPO. 2 of their investments completed an acquisition. It looks like one of their companies is having some problems, so they wrote off the value for this company and brought it down to 0. They have $10 million invested in Varo Money. This is the first fintech company to receive bank charter approval. SoFi is a second company. They received approval this month. They participated in a Series D round for this company, Orchard Technologies. They invested $10 million. They realized a $41 million gain on Coursera. So they invested $8 million and sold that investment for $48 million, and their realized gain was $40.8 million. Skillsoft, they had a realized loss of $100,000. Here are some more realized gains from the company. They had another realized gain on Coursera for $29 million. This is the most important thing. This kind of highlights the balance sheet. The net assets is how you value the stock. You take the net assets divided by the shares outstanding, and that gives you the stock price. On July 1st, it was $16.56 a share. On 9/30, it was $14.79. This is the book value of the shares, not what they're actually trading at in the open market, because the stock trades at a premium or discount depending on supply and demand. Because if this company owns some really garbage stocks, then investors may only be willing to pay $5 or $6 for a share of the stock. But if this company owns some amazing stocks, they may be willing to pay more, like $20 a share. Those examples are pretty extreme, but I'm just giving you the idea. Closed-end funds trade at a premium or discount to book value. Open-end funds trade at book value, because open-end funds aren't traded in the open market. Here's a breakdown of their portfolio by sector. 46% in education, the dollar amount is $146 million. 18% in marketplaces, 25% in fintech, 6% in social mobile, 4% in cloud and big data. Simply, Wall Street values the stock almost exactly where they're trading at. 2 analysts priced this stock, and the low is 15, the high is 18. This is where the stock has been trading the last 2 years. So 2 years ago was really low, around $3 a share at its lowest. But you can see the stock moves around a lot. It's really based on the underlying performance of its investments. You'll see on Yahoo Finance and other websites that their dividend yield is 60%. This is correct and incorrect. If you sum up all the dividends they paid in 2021, then divide by the stock price, that is around 60%. The company paid 5 dividends in 2021. A 25-cent cash dividend, another 25-cent cash dividend, $2.50 in a mixture of cash and stock, $2.25 in a mixture of cash and stock, and $2 in a mixture of cash and stock. On the statement of cash flows, it says they paid $75 million in cash dividends in the first 9 months of 2021. And they have 31 million shares outstanding, so that's $2.41 per share. The way to calculate dividend yield, it's the dividends they paid over market cap. Just in the first 9 months of 2021, they paid a 19% cash dividend. There are 95 companies in the same industry as SuRo. They rank 68th in market cap at $388 million. The average is $7.9 billion. Remember earlier I said price to book is the most important metric, and their price to book is really good at 0.9, but you want to track this over time. You can have the best price to book in the world, but if all your investments are of terrible companies, it really doesn't mean much. So you want to make sure the investments are also good. They have a beta of 1.52, so the stock moves 1.5 times the market. It's gone down 11% in the past 52 weeks, while the S&P is up 18%. The 52-week low is 11, the high is 16. And the stock is trading below its 50-day and 200-day moving average. 400,000 shares are traded each day on this stock. Of the 31 million shares outstanding, 26 million are on float. 27% are held by institutions. 8.5% of the shares are shorted. They only employ 7 people. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $24,000 today. That's a 9% annual return. The reason it's gone up so much recently is because of all the SPAC mergers. SPACs go up a lot in price initially, but then they crash. As long as this company doesn't hold on to the stock too long, they should be okay. There's been insider buying and selling. 930,000 shares have been sold. 40,000 shares have been purchased. Here's a list of all the insiders that have bought and sold the stock. Ronnie Lott is an insider. The ex-safety for the 49ers. 62% of the company is owned by the general public, 28% by institutions, and 10% by insiders. The biggest shareholder is Robert Birch at 7%, then Mark Klein at 2.7%, Bulldog Investors, Impacts, and Citadel. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.